Before we start this video, do like and subscribe to our channel and not miss on any updates.
What is the role of a CFO or advanced role of a CFO in value creation? CFOs have been traditionally associated with roles like compliance, bookkeeping, accounting, and corporate governance. However, post the pandemic, there has been a substantial change. CFOs are now expected to contribute to the business. They are expected to take part in risk management. They are expected to provide value addition in supply chain management. And with the evolution of ESG, which is environment, social, and governance, their role has become all the more important. What are three fundamental elements of a business? Strategy plus finance plus management is equal to business. A clear strategy plus funds and resources to raise the finance, plus financial controls and systems to see it through, and a solid team that can help actually make your strategy happen by using the financial resources. So, strategy plus finance plus management is equal to business. What is strategic financial management? Strategic financial management is application of the techniques of financial management for implementing a strategy so that the entity can generate returns and maximize the value for all stakeholders. It involves allocation of scarce resources, using them in the right strategy by the right team to achieve the end goal of value maximization. So it combines the backward-looking function of accounting with the forward-looking function of finance. It also involves implementation of the strategy and monitoring and making suitable corrections to the strategy to ensure that the end goals are met. What are the functions of strategic financial management, or what are the three levels of financial planning? Strategic financial plan is the part of the overall corporate plan where you actually allocate resources and use a strategy to achieve the overall objective. It consists of three levels of plans. One is strategic planning, which is primarily done by the board or senior management, and it is long-term in nature. It is more strategic in nature. Two, you have the tactical planning. Tactical planning is done by mid-level management. It is medium-term oriented. And three, you have the operational plan, which is the focus of your operating line management, and it is very, very short-term. So these three are the three layers of financial planning. What are the functions of SFM, or what is the strategic problem for financial management? The functions of SFM involve 5 alphabets: S, S, M, C, A. First S stands for searching for various investment decisions. Second S stands for selecting the best investment decision. M stands for selecting the optimal mix of funds in order to make the investment. C stands for controls. So deploying or designing a set of systems, control processes to ensure that particular investment is actually going as per the plan. And then A, and analyze the results for future decision making process. So SSMCA basically stands for the functions of SFM. What are the key decisions falling in the scope of financial strategy? You basically have 4 key decisions that one is supposed to make. You have your financing decisions, you have your investment decisions, you have your dividend decisions, and then you have your portfolio decisions. Financing decisions basically involve the mode of financing. How should you raise money, whether debt or equity, or what is the mix? Then you have investment decisions. Investment decisions involve in where to basically allocate the capital that has been raised. What kind of investment should be made, which is the right investment, and selecting the right investment. Then you have dividend decisions. Out of the returns that are generated, how much dividend should be retained for reinvestment, and how much dividend should be distributed to the shareholders. And finally, you have the portfolio decisions, where you basically evaluate all the investments that are made and compare the various constituents of the portfolio with each other to see which is the best performing investment and which is not, and which investments should you continue to hold and which investment you should exit. So these are the 4 key decisions that fall within the scope of financial strategy. What are the 3 levels of strategies? You have corporate level strategy, you have business level strategy, and you have functional level strategy. Corporate level strategy is designed by the senior management. Corporate level strategies have to answer 3 basic questions: suitability, feasibility, and acceptability. Suitability is whether this particular strategy is suitable for the current circumstances. Feasibility, whether it makes economic sense. And acceptability, whether it will generate sufficient returns and is acceptable to the stakeholders. Then you have business level strategy. Business level or business unit level strategies are designed by the middle management. These kind of strategies focus on operationalizing the corporate level strategies. They focus on plans, budgets, setting of targets, meeting targets, so on and so forth. Then you have functional level strategy. These are the people at the shop floor, at the bottom level. They are the actual execution level strategies. These are very, very tactical. And at this place, once the strategies are implemented, they actually have a feedback loop where they pass on the feedback of the implementation and the results and the issues, if any, they pass it back to the business units as well as at the corporate level. These are 3 levels of strategy. Differentiate between corporate and financial strategy. Corporate strategy is more concerned with where to deploy funds. It is more concerned with the asset side of the business. It is more concerned with what kind of investment should we make. Whereas financial strategy is more concerned with the liability side of the balance sheet. It is concerned with how to raise the money. It is concerned with debt, equity, mix, and so on and so forth. So the corporate level strategy is more about deployment of funds, which is the asset side of the business, and the financial strategy is more about sourcing of funds, which is the liability side of the balance sheet. What is financial planning? Financial planning comprises of three critical aspects. It is utilization of financial resources by using variety of tools. Basically, the resources are deployed using a variety of tools to ensure that your financial goals are met. So simply put, financial planning is equal to FR plus FT plus FG. Financial objectives, financial decision making, and financial measures. Financial objectives are basically the objectives that are set at the start of the process. They have to be in alignment with the corporate mission and objectives. You choose the way in which you evaluate the particular investment. You pre-decide the way in which you evaluate the corporate performance. Then you have financial decision making, basically involves analyzing financial problems that are faced and the decisions that are taken by the corporate as they implement a corporate plan. And then finally, you have financial measures. Measures like ratio analysis, cash flow analysis, and variety of such tools are used to evaluate the performance of the company. These have to be in alignment with corporate objectives. What is the interface of financial policy and strategic management? Though you're both financial policy and corporate strategy, both of them deal with money, they deal with them in a very different way. Financial policy is about raising the money and corporate strategy is about deploying the money. However, when corporate strategy is designed or created, at the same time, you should also think about how you're going to raise the money. It cannot be so that you first make the corporate strategy and then try and figure out how to raise the money. The entire process is about making a plan, raising the money, generating profits out of the money, safeguarding the money, and then reinvesting the money in new investment projects. In addition, this is broadly the way in which financial policy and corporate strategy interact with each other. Also, please note, financing decisions, investment decisions, dividend decisions, and portfolio decisions form a very, very key part of this entire framework of financial policy and corporate strategy. What are the financing decisions an organization faces? There are two key financing decisions. One is sourcing of funds and the other one is capital structure. Now, what are the factors that affect the sourcing of funds? The cost of capital obviously is the first one. And then what are the risks associated with raising capital by that particular mode of financing? Then you also have issues around cash flow, whether existing cash flow will be able to support repayment of such particular source from where you've raised the money. And of course, there are control considerations. Then coming to the capital structure, one of the factors that determine capital structure is dependent on the nature of the industry. It is dependent on the economic environment, the kind of sector in which it is, the stage of maturity of the industry in which it is, the stage of maturity of the company, what it is. And of course, it also depends on the larger macroeconomic environment. The mix of debt and equity in the capital structure of an organization is a fine balance that an organization strives to achieve. Both financial policy and corporate strategy to a large extent depend on the sourcing of funds, the cost of funds, as well as the capital structure that the organization proposes to have. What are the key components of a firm's dividend policy? A dividend policy will have three clear elements. What are the objectives? What are the factors affecting it? And what is the frequency with which dividend is paid? And the types of dividend policy typically are, you have a fixed dividend, you have a variable dividend, or you have some kind of a mixed kind of a structure. A fixed dividend is every year you pay a fixed amount as a dividend. A variable dividend is basically a percentage of profits. A hybrid structure is some kind of a step-up function where you have some amount fixed and some amount variable. And the factors that affect these dividend payouts basically are intentions or the objectives of the company. What are the further investment opportunities available? What is the returns on those investment opportunities available? What are the returns that the shareholders are expecting? What is the taxation policy which could impact the shareholders? And of course, the cash flow position of the organization. So these are the factors that impact the dividend policy decisions. How does an organization balance its financial goals with its sustainable growth rate? What is sustainable growth? Sustainable growth rate is basically SGR, what we normally define as your ROE into 1 minus payout ratio. Sustainable growth rate is the rate at which an organization can grow without taking any fresh equity and by meeting all its existing debt obligations. So while computing the sustainable growth rate, an organization should consider both its long-term as well as short-term aspirations and goals. Because sustainable growth rate is growth rate that an organization can possibly achieve and what it actually is expected to achieve in long term. What are the assumptions for sustainable growth? A very clearly well laid out defined dividend policy, no fresh equity being raised, and maintaining the targeted capital structure. These are the three key assumptions for sustainable growth. What are the various components that actually affect the sustainable growth rate? If an entity has multiple channels of income or multiple sources of income, then degrowth in one particular channel, business or segment can be offset by growth in another channel or segment. Same way, the kind of systems that it has, the kind of risk management systems it has, the kind of management, the quality of the management that it has, all determine the kind of sustainable growth rate that an organization can achieve. Similarly, the infrastructure, the intellectual property that the organization has, the kind of dependency on external capital, the greater the dependence on external capital, the lower will be the financial autonomy. In that case, achieving sustainable growth rate will be difficult. And finally, and most importantly, the clarity of corporate objectives, vision, mission, all these play a very large role in how an organization achieves and maintains a sustainable growth. What is the linkage between growth strategy and growth capability? In order to achieve and maintain a sustainable growth, an organization should have both the capability to grow, that is basically the resources, the talent, the management, and also should have a strategy on how it wishes to achieve its corporate objectives or how it wishes to achieve or maximize shareholder value. Growth capability depends on the quality of the management, the execution capacity of the management, the resources that it has, the tools that it has, that can be used to achieve the corporate strategy. A strategy with large mission, vision, and large goals and ideals without actually having the capability or the executionary capability is of no use. And hence, both these aspects, growth capability and growth strategy, are very, very important and are closely interlinked for an organization to achieve sustainable growth. What are the types of sustainable growth policies? There are three types: weak, medium, and strong. In a weak sustainable growth policy, there is no reduction in the asset structure, whereas in a medium sustainable growth policy, the critical functions continue without any disturbance. Whereas in a strong sustainable growth policy, an organization will thrive despite challenges, despite obstacles. It will continue to thrive even in a dynamic ecosystem. What is the linkage between inflation and growth? For a mature industry or a mature sector, inflation impacts growth negatively. As inflation increases and the lenders insist on maintaining debt to equity ratio on a historical cost basis, the firm, in order to maintain the debt equity ratio, will have to keep funding more money into equity. Why is that? Because working capital needs increase and the lenders refuse to give debt because they want to maintain a historical cost convention based debt to equity ratio. The company will be forced to reinvest all the money it generates in working capital so that the debt equity ratio is maintained at the same levels despite a substantial increase in cost. This leads to lower availability of funds for investment in new projects. As a consequence, the investments in your projects come down and hence the returns come down. Or the returns remain same whereas the equity deployed increases. So the base increases and the ROE decreases. As ROE decreases, sustainable growth rate decreases. So this way, inflation has a negative impact on mature firms, especially when lenders force such organizations to maintain debt equity ratio computed on historical cost basis. What makes an organization sustainable? For an organization to be sustainable, it needs to have very clear idea of what its goals are, what is its vision, what is its mission, and what is the strategy that it is working towards to. In addition, it should be able to operate in a dynamic environment. It should be able to make investment opportunities even in a dynamic environment. It should be able to raise and arrange for resources effectively, and it should be also able to use those resources efficiently. What are the resources that we are talking about? We are talking about capital resources. We are talking about human resources, basically talent, people who will run the show. And then it also should have the administrative and other additional infrastructure that is required to run an organization effectively and efficiently. In addition, it also needs to convince and carry together all the stakeholders, the equity shareholders, the lenders, the bankers, the customers, the suppliers, the vendors, the society, and the government. All these aspects, when are considered by an organization and are acted upon by an organization effectively, will ensure that the organization is sustainable in long term.